Alright guys, so this is a video giving some chart data to David Jaffe's very interesting video on how he handles bad trades, specifically Tesla and snow back in like December to February 21 time frame. I actually went through and had his audio and text visuals in the original attempt at this video in multiple parts and a lot of pausing to get the information together for you guys in a more succinct form, but my audio didn't work. I found out at the very end, so that might work out in your favor though, because I'm going to just summarize it very briefly here. So basically, this is the video, options trading, handling bad trades, on his best stock strategy channel. I'll put the link in the description. But basically, in summary, I've been studying different trading strategies for like a year now, trying to find one that seems successful, let a paper trade it. It seems like I understand it and makes money. So I'm definitely in the corner. I'm definitely in the corner of selling options for premium. So you're kind of like the house in a casino, or you're an insurance company, because you probably have read by now if you're watching this, most options buyers lose all their money. I think it's 90% of the time or more or something. So option sellers, more likely that you're gonna come out ahead as these options expire. And there's a curve you could find. It's really that last 6 weeks that they really start deteriorating from the time value of the theta, and it becomes more rapid as the days go by. So that last couple of weeks especially. So David's strategy seems to be selling especially puts on good stocks, solid companies, market leaders, paying close attention to those, watching the range, and then making some money on the premium. So spoiler alert, he does end up coming out ahead on this, but it just seems like about as bad as it could get on this backfiring on you. So basically he will watch a range for a few weeks as a daily chart. So I guess Snow IPO'd here. I'm not sure, I have to look into more why he would have sold options on Snow, because I don't really consider that a market leader. But I don't know, if anything, it just seems like a volatile stock I don't know much about. But anyway, assuming that you would have got in on it, it was ranged from like 208 to 300-ish. And so then on this day, that's what that arrow is there for, is when I guess he had a trade trigger. And so he buys, that's what this rectangle is, he sells a put and a call, and has the spread here. And so a couple of days go by, and I guess here he's having a tough day, because the stock is sort of continues to rocket up. Like he originally buys it here, where it's like a second really good day. It's breaking out of that range quite a bit, and he figures I can get great premium, especially on the call side as this stock rockets up. But he feels like it's out of bounds at that point, and so a good time to sell a call. So he sells a put as well for extra premium, I guess. But the stock a couple days later, we're on December 8th, just kind of rockets up on him. Basically looks like it touches his strike. Now that would have been okay in hindsight, because you're not normally going to be called on or signed on an option unless it's the last day or two before expiration. At least that's what I've learned. So if he had held tight until the next day, he would have seen it come back down, probably would have felt a lot better about it, and probably would have held on to this original spread and done well, because I don't remember the expiration exactly, but I think it was just a few days out. So anyway, at this point, it's touching his strike on the call side, so he starts rolling, and so he goes for a little bit higher call, which would have got him out of the woods here, but then his put had to come up quite a bit to still roll this spread and not have to pay a debit. And one thing about David, watching his videos, almost, I don't think I've ever seen him have to pay on a losing trade overall. Like, it's always positive, 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 if you consider the whole trade start to finish. So every time he rolls, he's looking for a credit, even if it's just a penny or a dollar equivalent. So, which is good. I mean, I think that I would like to follow that same program if I could, kind of never lose, even if it's small increments. Now, the downside to that is you're tying up the buying power of 100 shares of Snow per contract, which is a $200 stock, so kind of $20,000 of buying power. But the way that works in real life is the brokerage usually only takes about something like a fifth of that buying power, give or take. But still, it's thousands of buying power while you're doing all this. But basically, he rolls that up, and then these are the days that he's making other moves. So I guess that's when it IPO'd back in whatever that is it September? And then we're in December looking at this. So this day, let's move this out a bit. He basically takes this spread and decides, you know what, this is dropping so fast that I better give myself some more cushion on the put side. So I guess these were the first. These moves were in order, and these rectangles are the call, and that's like call up here, put down here where he's selling. And so your goal is to have the stock's price stay in this range on each of these rectangles. So he rolls this one up a bit on the call and put, but he sacrifices so much on the put side to get a little incremental call side. Still comes out with a credit though, making this move, which is cool. Then he does it again. I think he was up to 450 on the call side, trying to get some cushion, moved his put up even more. But these moves are happening like back here. So he's not as worried about the put side, obviously, because it's like, I think most of this, like 3 of these moves were on this one day. And then he realizes, oh, it's dropping fast. I need some cushion on my put side. So he starts expanding that. Now, the call option can come down in price as he does that, which will gain him a credit because it's moving closer to the strike price of the stock. But he's going to have to spend to get these puts lower, and he never wants to make a roll move for a debit. He always seems to always strive to get a credit. So he is going down, I guess, expanding this put a little bit. I think he's decided to do that somewhere in here, and then goes, same ideas. And then on this day, that's what that blue arrow means, is when he decides to do that. December 14th, so he's at this level and he sees, I gotta make another move here. It's past my strike. So on this day, he decides to move the put down further. Call comes down with it. He comes out with a little bit of a credit. These are all, as I recall in his video, credits between like $1 and maybe up to like, I don't know, $30. Most of these moves are small incremental. The first one was pretty good. I think it was a couple $100 or something. But all these rolls are very small incremental credits. And here he moves the strike. On this day, he moves the put strike down. And then on the next day, he sees the stock is going further, either about to cross his strike or is past his strike. I think it would have started on the low end in the morning probably, because these candles are open at the bottom and close at the top when they're green. So on this day, he rolls for this, where it's at like put 295. So this is another one where I'm not sure exactly what the expiration was at the time, but these are chronological order. He might have been okay leaving that alone. But that's hindsight. You just don't know when you're doing it. So then this was a very busy day. That's why I circled it. That was December 31st in his video. So you see he made two different moves that same day. So it was a day that probably started up here and dropped a lot, and he was probably at this level on his put. This was the latest one before this move, and he was probably feeling, oh, I'm okay, even though it's dropping, I'm okay, it's getting hairy, and this day's like, I gotta make a move. So he drops the strike, pays money to do that, but also, look, the call comes down. I believe he moved out in time as well. So made that move, and it would have been close. I think that was a 280. So then the same day, he moves it again, and I'm pretty sure that to do that major decrease in his put strike price, that he had to move the dates out quite a bit. I couldn't figure out a good way to reflect the dates of these options, but the basic concept is, you know, if you're trying to move your strike price of your call or your put in a direction to buy you some more cushion, you're usually paying for that if you keep the same expiration date. But if you move the date out, so you're kind of at risk for longer, usually you move these out a week or more at a time of expiration dates, then you can usually get a credit for that because the time is worth money in options. So he moves it there, and then he moves it again, but I think he moved the date out quite a bit to get that huge drop, and that was, let's see, on this, this was the day, it was the next day that he was kind of like, I'm over it, I'm going to move this out. So I remember that was from New Year's Eve, kind of to after the holiday weekend. He was probably like, I'm so done with this, so he moves it way down. But I remember this put was like expiring out in May, and he was like, if I get assigned, you know, so be it, or maybe not assigned, but he felt like he could manage this better because it would have been back in kind of like a reasonable range, even a little on the low side of where he originally expected it to stay. So then, a few days later, he sees a big up day. So now I guess he's concerned again about the call side. So he moves things up a bit, like that. So on this day, the arrow's pointing to this day, is where he makes the decision to make this change in his strike, or call and put strikes. So then the next move he does on this day, and let's see, so he's kind of in the middle range here. I think this move might have been just to shave off some time. Actually, this move was first. This thin blue line he had moved to put there, later bought it back in a roll, so that's why it's kind of a different looking line, and there's no rectangle here because it just disappeared a few days later. But then, let's see, made that move, and then here he makes this move, so I think he's just trying to have the expiration date a lot sooner so he can get out of the trade sooner. And let's see, on this day, he makes, so we are on January 19th, which you can see the dates on his text in the video. He is kind of in the middle here. He does this move where he's putting a lot more cushion on the call side and moving the put just a bit, and I think the reason for that was also to subtract some time off the expiration of these options. And then that same day, this yellow line just indicates that he moved his put up quite a bit because he had another put going on still. Moved it up and way out in the date. I think that was to get some more credit to be able to finance this spread here, which is, you know, it's a wider spread, so that would have cost money versus this one. So he's gaining some money by extending this put out in time. It's a little higher, but I think overall he made some money on that. And then ends up, anyway, in the end, there's more here. Yeah, so some of these are way out here because, you know, there was one out in like May, which is this, that would have been out here somewhere, like, I think it was late May actually. So way out here, he had something expiring, but he kept trying to shave off time, so he moved one up here, over here, and most of this is happening in these days here, and then finally he just ends it by buying back the last put for $300. But by that point, each one of these is making a few bucks. The original trade made, let's see, so yeah, he originally made $380, and then let's see some of these other ones. That was just 5 cents, but I think there was another one that was like 100, 20 bucks here and there. I think there was an early one where he made like, there's one that made like 100 bucks there. So when you add all those credits up, he actually made like 600 plus, and then at the end just was able to just sell it, the last put for 300 just to get it over with. So like whatever, 12, 13 different rolls of this position, dates all over the place, but he does a good job keeping track of it. I guess the OCD tendencies help him with that. So I'm not as OCD, so I think that that would make his service valuable to me. And like I said, in hindsight, the original spread probably would have been fine. It could have avoided all this grief, but you just don't know that at the time. He was on this day where it's spiking up, continues to spike up, you know, unexpectedly. I see him, and so he's like, I gotta cushion this, and then, you know, you don't want to have a debit where you're basically have a losing trade. So he's kind of doing everything in his power to avoid that, and by using the value of the time, putting some of these options out and some other masterful creative techniques, he's able to end up coming out ahead on this trade. He would admit totally not worth it, but this is all the changes. Like I said, I couldn't get the dates quite right, but you know, to account for the dates, because like some of these would have like a call that expires on the date where the rectangle is, but then the put might be way out in May and stuff like that. It's hard to put that in a chart, but these are basically all the moves he made and on the days that he made them with the blue arrows. I didn't do it early on, but you can kind of understand by looking at that, like on this day he decided to move the spread down a bit, and you could understand why, because this is falling. It's like this was the day where he made, I think, a few moves, and you know, stock was dropping, his strike was there, and then he moves it out so that it's further down. I guess that's this one, but like that holiday weekend over the New Year's, and then like let's say for example this one, stock was dropping, he had a bunch that were things that were expiring in March, April, May, so he was trying to tighten that up, bring those dates further in, and you could see how the stock sort of stabilized some, and he was able to kind of reel that in and get the dates shorter. Here it was just a nightmare because the stock, this was over a 130 point range that it just blasted through out of the channel that he thought it was going to stay in. So that's the nightmare scenario. That's what is risky about any option selling program, is that the stock just goes berserk on you. The more stable and predictable they are, the easier it is to make money. But he has a great track record that he has documented on YouTube. My only concern is these nightmare scenarios, and he has this example, Tesla example, that's not quite such a headache, and I think a couple others, real P&L, documented one while he was trying out the service, I think for a week or two, that was similar, where he just rolls it if he needs to. He uses further out expirations to get those credits, so that each roll there's a credit, and I mean, you gotta love it. So I don't know if I could do it, but maybe after a few months following him I could get better at it. But I just wanted to share that with you guys. You watch his video and then take a look at my chart. maybe freeze frame it on a separate tab, and I bet you could follow along pretty well. I mean, you see the dates down here, maybe probably put it like that. I mean, some of these are actually in May, but I didn't go out that far. But most of these moves are where these arrows are, and you can kind of decide, hey, on that day, I can see what he was thinking. Helps a lot because on his video, he doesn't have the chart up for you to follow. All right, I hope that helps, guys. Let me know if you have any questions. Like and subscribe.